So how we dissect and analyze equity returns has changed through history. In the 70s, we simply looked through the lens of portfolio returns. In the 80s, we went a level further to distinguish between market beta and alpha. The 90s then introduced us to the work of Eugene Farmer and Kenneth French, who dissected returns into style risk premia. In other words, distinct factor characteristics which they argued were systematic and persistent sources of return. Now, both market beta, i.e. passive market returns, and style risk premia, we would argue, are both heavily influenced by macro forces. In a seminal paper in 1992, Farmer and French showed that two factors, size and value, can pretty much explain cross-sectional market returns, namely that smaller companies outperform larger ones and undervalued companies outperform overvalued ones. Since then, many more styles have been developed, and some of these are shown on this slide, but we're going to focus on the two most popular, value and growth. So value stocks are defined as stocks that are out of favor, viewed overly pessimistically by the consensus. They're characterized by low price to book and PE and high dividend yield. Typically, value sectors are energy and financials. Now, energy and financials are value cyclicals. They are geared to economic health and growth when profits are rising. And given their short duration cash flows, i.e. cash flows occurring in the near term rather than in the distant future, they are less sensitive to rising interest rates. Indeed, when inflation and pricing power is rising, it has historically been a good environment for energy and banks. Growth stocks are defined as stocks with a proven superior track record of earnings growth. The assumption behind growth investing is that the market will continue to reward the superior grower. Typical growth stocks are technology, parts of consumer discretionary and healthcare. Now, interest rates and inflation clearly matter here. Tech companies have a greater proportion of their cash flows in the distant future. They are long duration, which makes them more sensitive to changes in the cost of capital. So they want lower inflation and lower interest rates.